Harsha Upadhyay, CIO Equity of Kotak Mutual Fund, is with us. Harsha, good morning. How things change, right? It was just about 10 days back that we are wondering whether 10,000 would hold or not, and now we're already talking about the possibility of the market going back to perhaps 11,000. Your thoughts on the kind of move that we have seen from the lows and whether the Indian market has truly put the worst behind?
Anuj, clearly equity markets never move linearly, and whenever they do, I think there is some amount of risk on the other side. What we have seen in the last couple of trading sessions is clearly a pullback. We haven't seen any of the macros improving as yet. Yes, there is some stability in crude prices, there is some stability in currency, which is also related to how the crude is moving in the global markets. But apart from that, we haven't really seen any improvement in some of the macro challenges that our economy is facing. So to that extent, one can't rule out further correction in the market. So our approach will be more cautious from here on.
Okay. Good morning, Harsha. Greetings of the season to you. As of end September, Kotak Standard Multicap has become the largest equity fund in the industry. So more congratulations to you for that. Where will you put the extra money if you're so cautious?
Thank you, Lata. Thank you. We are trying to find some opportunities in the mid and small cap category. We can't rule out further correction in the basket, but we believe if you look at the small cap index and the mid cap index today, they are almost at similar levels when Nifty was at around 9,000 last time. So clearly there has been significant correction in the mid and small cap basket. Not that all mid caps or all small caps are worth buying at this point of time, because they will also face issues when the macro challenges are there. But I think increasingly, if the correction continues, you could find more value in mid and small cap. And from our next couple of quarters perspective, I think that is a segment where we will look to actually look for more opportunities.
If you look at the Kotak Select Focus Fund, Harsha, good morning. This is Sonia here. If you look at the Kotak Select Focus Fund, over the last 3 years, you've given returns of about 15%. The last 5 years has been return of 20%. It has been a good market so far, but do you think you can replicate these kind of returns over the next 2 to 3 years as well?
Sonia, whatever returns we will be able to achieve will be dependent on how the market does over the next few years. Clearly, in the short term, we cannot expect anything but moderate returns from equity. But I think once the macro headwinds start to improve and there is some clarity in terms of the political setup post 2019, I think we will again get back into higher valuation zone. That's our belief at this point of time. The earnings recovery is clearly in place. There are cyclical improvements that we are seeing across the board in many industry segments. Our belief is, from a 3-year perspective, the earnings growth should still be in the 12 to 15% kind of CAGR levels. And if that is going to happen, then I think we can expect at least similar returns from equity markets as well.
Harsha, interesting reaction to earnings from TCS and even Infosys to a certain extent. There's one part of the market which believes this IT story is done, this rupee tailwind is now perhaps done, and this is the most overcrowded trade. Would you agree with that view, or do you think this is still the sector to put your money on right now?
I think clearly in times of volatility, IT sector will remain as a defensive bet. But we really don't know from a 3-year perspective whether it will still outperform market. Our call on the sector would be to look for exits if the sector continues to outperform in this volatility, and start getting into some of the cyclical names which will offer better upside from a 3 to 5 year perspective, but may continue to underperform in the short term. But as long as we are okay from our overall portfolio construct, we will start to move some bit of IT weight into those segments. But that is still some time away, I guess. I think initially in the short term, IT will still provide that hiding space.
What are your colleagues in the debt funds telling you? Are they getting back the money that went away in September?
Yeah, I think slowly the industry is getting back to normalcy. It's not that all mutual funds or all schemes which saw redemptions are getting the money back, but I think clearly there has been a change in terms of how the inflows have been. I think the stronger fund houses with no credit issues in the portfolios are getting bulk of the flows. But slowly, I think overall market is getting normalized.
Okay, so which part of the financials will you buy? Will you dare to buy NBFCs, or will you look for an opportunity to shed them and get into others?
Lata, as we have been discussing over the last couple of quarters, we didn't see any margin of safety in NBFC valuations. And for the same reason, we were completely out of NBFCs, I could say. I mean, except for one or two names that we had, where we still have positions, and we believe that there are hardly any funding issues or any other risk issues coming from the asset side. But apart from that, even though we have seen a sharp correction, we are not really looking at increasing exposure to NBFC segment. We believe that clearly the private sector banks which are focused on similar businesses have an advantage here. The interest costs are moving up, which means the wholesale borrowers, which are essentially the NBFCs, will continue to have issues on the funding. At best, they will have lower margins. At worst, they could have issues in terms of growth itself. But for retail private sector banks, I think there is a lot of cushion that they have in terms of lower cost of funding, which is coming from CASA. I think that's a great advantage in this scenario. So we would rather be staying in the private retail sector banks that we have in our portfolio.
Okay, I guess that comes right on cue, because you're seeing a big sell-off in the NBFC space currently. Not just Divan Housing, which is down 5.5%. Look at Indiabulls Housing. It's lost 5.5%, and a lot of volume damage seen there as well. I mean, it's selling off on high volumes, so keep that in mind. Harsha, one of the stocks in your, one of your top holdings in the Select Focus Fund is Hero MotoCorp. What we're seeing with the two-wheeler space now is a double whammy. On one hand, a slower demand, and on the other hand, you have a higher commodity costs. You think this space is going to underperform the market now, or would you still keep the faith?
I think compared to what our expectations were maybe a couple of quarters back, I think we have to tone down in terms of the growth projections, and also maybe some compression in terms of margins. But I think this is one of the safer sectors given where the valuations are to remain invested. We are not looking to increase our allocation to the auto sector. In many of our schemes, including Select Focus, we are currently underweight on the sector. We will continue with that position and look for more clarity in terms of growth revival or margin improvement. And post that, we will look for further increase in position.
Okay, well, at the moment, if you sold at any point, at 9.15, 9.16, 9.17, 9.18, you would be in the money, because the market is ticking slowly, oh so slowly, but it is ticking only in one direction.
Is set for another bit of accident here. 9% lower is what you have on Divan Housing, and it's just the volumes are piling on, and if you see the, there's almost no buying in terms of volumes. There's only 1 lakh on the buy side and about 40 lakh on the sell side. So will be interesting to see.
The other NBFC,
10% circuit, yeah.
Indiabulls is also
in fact, it's now 10% circuit on DHFL, so it could really get interesting today. And that's the problem. Some of these companies, like DHFL in particular, that day when we're talking about, SBI buying the assets.
It's not yet 10%. It was 8.
It's in the futures. It is in the futures. It is. So I think it's already seeing quite a bit of short. In fact, let's pull out the futures plate of DHFL. It's already at 240 in futures. That's a 7 rupee discount that you have right now, and that's a 10% circuit in futures. Not there in spot yet, but people already willing to short DHFL. So that obviously stands out right now.
My worry is it's just spreading the contagion, because Indiabulls Housing, after posting decent numbers, has not been able to keep the market's nerve. It's down 6% now, so just a little bit better than DHFL, you will have to say. But it's spreading to everyone now. Edelweiss, L&T Finance, JM Financial, LIC Housing, Can Fin, all of them are down in various degrees, between 1% and 3% the others. But DHFL and Indiabulls are leading the pack. So clearly people have used the bunch of good news to sell into it.
Oh, absolutely. Harsha, you were talking about how you're cautious in the very near term for the market. We've already seen a 15% slide for the MSCI Emerging Market Index so far. Even MSCI India is down more than 15% this year. What are your thoughts? Do you expect to see more of a correction in the Indian markets? And if yes, how much more are we looking at?
It's always difficult to predict index levels or valuation levels, but our belief is unless the macro headwinds start to normalize, there is no room for markets to really go up. So to that extent, our approach would be to look for opportunities on the downside, and if market corrects, we'll get more constructive on the overall portfolios. That's what our approach would be.
Well, it appears that there is going to be the liquidity crunch continuing. Harsha, how do you play that theme? You said that, of course, you will be buying the private sector banks, but is there any avoids because of the high cost of money?
I think clearly NBFC sector continues to
Yes.
remain one of the sectors to avoid at this point of time. Apart from that, we also believe that some amount of discretionary consumer demand could get affected. One, we already had the petroleum prices going up and burning a hole in the pockets of consumers. And on top of that, the lending that was so easily available for discretionary consumption may start to get curtailed a little bit. If that happens, I think post-festival season, we could see some amount of drag on discretionary spend. And that is another sector where the valuations are on the higher side and could face some issues if the growth comes down.
All right, Harsha, we'll leave it at that. Thank you so much for joining us and giving us your view on the market.